Okay, folks, welcome back. All right, so we're at our update for model number 3 for swing trading, and it's April 19th, 2019. Happy Passover. So, again, this model is specifically dealing with swing trading, which is an intermediate term style to short term style. I'm not going to rehash everything that was covered in this video here. You guys can obviously, and you should be watching it again before watching this video. Otherwise, it's going to feel fragmented because it's been such a while since we revisited this model. Its focus is primarily on, and this is the reason why I did the outline like this, because it will allow me to come back to it each time we do a new video. So, again, the models for folks that don't have the ability or the capacity to day trade or short-term intraday trade scalping and need a little bit more oomph in terms of movement because of their time constraints or their personality limitations, do not allow for them to be a very small short-term trader. So they're looking for larger moves, primarily looking at the daily chart. It doesn't mean that we're not able to use the intraday components and concepts to help reduce the risk, because that's exactly what you should be doing. Not necessary, not required, but it helps. And that's the reason why we do 12 different models, because they will all complement. You'll see this at the end of all the presentation. When I'm done, when I say, okay, we are done talking about these models and whatever else direction I take the mentorship after that, it will be very easy for you to see how they interlock and interconnect with one another. They overlap beautifully, which is what gives me the ability to go in any time frame and trade. Now, admittedly, I don't like to do long-term or intermediate-term swing trading. It doesn't fit my personality. It doesn't mean that I can't point them out to you so you can pay attention to them. It just means that I personally don't really participate in them because my mind can be changed on a whim. And I'm very short-term attention span, that type of thing. So I like to be where I'm my best, and you guys can see that on Twitter. I'm a day trader at best, with the higher time frame, short-term, one shot, one kill, the weekly range. So this model, we like to look at any pair. Doesn't make a difference, any market. It can be a London or New York kill zone, and the trade objectives are going to be 100 to 300 pips on average. Sometimes it can be a lot more than that if there's a lot of things going behind it, like seasonal tendency, market structure. If it's a commodity, it may be a premium market where everything is backwards in terms of the delivery months. It's now more expensive in the nearby months than it is the further months out. So the trade frequency generally will be 1 to 2 times per month. And the reason why that is the case, because we're focusing on, as the presentation initially outlined, we're looking for that monthly candle to expand higher or lower. Okay, so if we have that prognostication behind the analysis suggesting that we're probably going to be moving higher or lower depending upon the market structure and the technicals at the time, because everything is relative to that. If we know that our tools and our concepts and our analysis are leading to the high probability that a prolonged move will see price advance higher or lower relative to the monthly chart, we're basically predicting the monthly candles, bullishness or bearishness. Now, because of that monthly candle, it's comprised of generally 4 weeks. So if we capture 1 week out of that month with a swing trade, we're successful. And it does not matter if that monthly candle closes near the high or bullishly. That's not the point. The point is we're trading inside of the order flow. And when the expansion occurs, it's seeking buy-side liquidity above the marketplace, or it's seeking sell-side liquidity below the marketplace. And all we're trying to do is capitalize on that displacement in price relative to the monthly range. So don't think that we have to have the monthly close in our favor. Many times my analysis lent very well to the directional bias for the trade, but sometimes the candle on the monthly basis actually reversed. And there's nothing wrong with that, because the basis of what we're trading is the liquidity, or the draw on liquidity, above or below the marketplace. So when we have these things in mind to build a model that builds a bias, it builds a setup, a framework, it's all based on that monthly expansion, higher or lower. Okay, so swing trading requires that all the time. That's the common denominator. That's the foundation, if you will, to solid swing trading. You don't see that in books. You don't get that from other people that are trying to teach swing trading, because they're just going in there looking for things, at the right now daily chart or less, and that doesn't bode well for high probability. You guys see, I don't lose a whole lot, and it's based on framing setups that would deem them to be high probability. So for swing trading, you have to have the underlying direction of that monthly candle that's to form next. That has to be bullish or bearish in your analysis. And if it's not, and you can't clearly ascertain what directional bias it is for that monthly candle that's going to form next, then you don't have a high probability condition. So you need to leave that model and go down to a lower time frame or model, which would be short-term trading. But again, that's outside the scope, but I just want to put that in here because you can include that for your notes. We'll talk about that as we go into other models. And again, it's not focused on any one particular day of the week. So it's very fluid. It allows a lot of flexibility. So we're going to go over to the Canadian dollar. All right, so we're looking at the Canadian dollar. Now, this is the futures market. Okay, so when we look at the futures market, we have to remember, if we're trading Forex, and I'm going to present this on both sides of the coin here. If we are a futures trader, okay, and we're paper trading or demo trading the Canadian dollar futures market, if we're looking for bearish prices on the futures contract for the Canadian dollar, that's going to be the opposite direction to what we'd expect to see happen in the dollar-CAD pair, because the first currency in the pair of dollar-CAD is the dollar. So when it moves up, that's the same thing as saying that the Canadian dollar futures market is going lower, and vice versa. Okay, so it's just make sure that you are aware of that and it doesn't confuse you. The line that's down here, okay, is the commercials. And what I've done is eliminated all the other small specs and large funds. And we're only focusing on the commercials. Okay, and you can do that on bar chart if you use the technical chart. And I'll show you what that one is, the link. Not the technical chart, I said that wrong, I'm sorry. The interactive chart. Usually I show you with the technical chart, but if you want to remove the large speculators and the small speculators and just show the commercials, you would just go into the studies here. And I have the little eyeball toggled. So it's got a little line in it, and only the commercials are showing the eyeball. If you want just the large specs to show up, you would do that. Okay, but I'm not going to do that. That's what we have here. We're applying that. And what we have is the market showing a willingness to want to go lower, obviously. And if we look at how price has worked lower all through here. All right, so if we look at just the line itself from a traditional view or perspective on committed traders, the zero basis line, this would look bullish. Okay, this is what's always confusing people with COT. It gets so frustrating that you're like, what is this? It's if we look at what they're saying relative to this chart here, or as Commitment of Traders data analysis that was taught by Larry Williams back in his How I Made $1 Million Trading Commodities Last Year book, classic. You need to have it in your library if you don't have it. He talked about how this was the underlying framework. And sometimes that's true, and most times it's not. So what we do for this model, number 3, is we use the hedging program, okay, which is we take the last 6 months, the last 12 months, the last 2 years, or last 4 years, depending upon what time frame you're looking at. But because we're swing trading, you can do this with the last 6 months, but we're sticking to the rules of the model number 3, original presentation, the last 12 months. So if we're looking at the November time period, in the fall, December time, we would go back about a full year, which is here, and we get the lowest reading on the commercials and the highest reading, and we split that in half. Okay, that's what we're looking for. And when we do that, it gives us a range. And that range will define whether or not we are really above or below based on their yearly maximum buying and maximum selling or hedging on both extremes. Once we have that range, we split it in half. Okay, so when we do that, it gives us a real clear depiction of what is underlying in terms of their bullishness or bearishness, because it gives us a boundary of what their highest point of hedging long and lowest point of hedging short. They're always doing buying and selling all day, every day, but the bulk or their net position is what we're tracking. So what I do is I look at the range, and this is obviously, like I mentioned in the mentorship, it's completely unique to me. And what it helps me do is define where we are in the real extremes. This perspective, I'm convinced, since everyone started doing it, the data gets skewed. So by removing the perspective of looking at like this, whether it's above or below the zero line, I create my own zero line by taking the highest range and the lowest range of the commercials net positions, and I treat it like an overbought, oversold. Then I split that in half, that range. If we're above or below that new zero line, it gives us a clear, at least it gives me a clear idea of whether I should be bullish or bearish on that market. So once you do that, you end up with this. Now, you see me do this in mentorship. I'm going to do this again because otherwise this video will be way, way long, and I don't want it to be way, way long. So this is the chart. All I did was copy it and drop it into Paint. Okay, and most computers have this. It's a free little app. It's inside. And what I do is I get the rectangle right here, and I draw it over top of the highest point and the lowest point right here. And then I turn on view here, and then I put the ruler and the grid lines on. And it helps me see the boxes that will represent the highest and the lowest range. And I just zoom in and I count the number of boxes. And then once I get a determination of how many boxes it is, I just divide that in half. Then I count down from the top or count up from the bottom to that number, which would be half of the range. And then I would draw a horizontal line across that, and it gives me a new zero basis line. Now notice mine is up here. Okay, this is my zero basis line, which is higher than the zero line based on the traditional view of Commitment Traders net position charts. So with this information, then I just go back and color in for you. I don't need to do this personally, but I do it for you. I go in and I take the little paint bucket here and I color in all the commercial line below the zero line. When it gets back above, I color it green, and when it's below, it's red. Okay, and that's what I'm seeing when I look at just this chart. When I look at that, I already know I can rough it visually where the midpoint is on the range. This is what you end up seeing. So all this time period here, their hedging was net long by a traditional analysis perspective using commitment traders, but it really is long based on the hedging program that I've used here by interpreting the data just slightly different. So I'm convinced that there's really no way for them to mess this up unless they just start to really delay the COT information. And if they do that, it'll just mean that there'll be more deviations in terms of their net holdings each time there's an update. So it really is, it's not going to change anything. It's just going to actually make it even better for me because I'll see them a lot sooner than it takes with this. It's a long-term approach to using quote-unquote fundamental data. So they're long in here, great. Okay, you can see all of the buying opportunities that took place. Bullish order block, it retrades back into it, rallies higher. Okay, we have a bullish order block in here, price trades down into it, heavy net long, buy, takes off. Okay, but notice what we have here. From October to December, we have the commercials in the hedging program, ICT version, bearish. And that's reflected with that movement lower here. And it wasn't until we got to this price point here towards the last week or so of December where we would start to see the commercials go long. So now these two camps, whether they're bearish or bullish, are changing. Okay, there's a changing in the tide, if you will, or the fundamentals. Now that doesn't mean it's time to get long Canadian dollar or short dollar CAD. It just means that they're now starting to have a larger degree of buying. They're hedging. It's not a turning point, okay? But what we see here all through this period from October through December, every time price rallies up to a up-close candle or bearish order block, there's an opportunity to sell short beautifully. Market rallies back up into a bearish order block, sells off beautifully. Now again, this is a daily chart, so this is all swing trades. Here's a bullish candle here, bearish order block. Price rallies right back up into it. Boom. With the commercials net short. But you don't see that because they're above the zero line relative to a retail perspective looking at it. They're not going to see commitment traders as bearish there. We do. Okay. And with that in there and institutional order flow, you have two of the strongest things in my repertoire working for you. We were expecting weakness in Canadian dollar. Go back and look at all the videos. You'll see all that stuff. If we are a commodity trader, okay, if we're paper trading, if you will, there's several things in here you could have done. And this is what you do going forward when you practice. You could use the order block, okay, use the order block and buy a put option, or not really buy it, but paper trade the price. As price rallies up into that order block, that's essentially the 76.50 level, 77. You can do a 77 put. And when price was rallying up into that order block here, or when it was rallying back up into the order block here, you can look at the 77 put, you can look at the 76 put, okay, and and they'll have an opportunity for you to paper trade the option. Or you can just simply paper trade or demo trade the outright short of the Canadian dollar futures market. We're going to focus on October to December for the Forex market. That means when the Canadian dollar for the commercial hedging program using the COT data here, when we have this bearish here, that's going to be the opposite for the dollar CAD pair. It's going to be bullish. So remember, from October through December, it's bullish dollar CAD because it's bearish Canadian futures. Okay. With that said, we're going to move over into the dollar CAD, and I'm going to start with the monthly chart here. We have down close candles here, which is a bullish order block. We have a small little candle body here with a wick that goes in that basically rebalances this volume imbalance. That stuff works on a monthly chart. Hello. This imbalance here volume imbalance. There's no candle body there, just a wick. And it only goes up through with this candle here. And it comes down, rebalances. So there's 2 passes it takes to get in here and fill that in. It does so here. Okay, beautiful return to an order block there. By itself, that's enough. That's this imbalance, fair value gap or void. That's what makes order blocks high probability. Otherwise, it's just a down close candle. We have the order block that starts with both consecutive down close candles. When we trade above it, this candle here, when we trade above it, we now have a valid order block for this level here. Otherwise, until we break above this in a meaningful way, it's not meaningful here because we have a wick and we close the body here. That means we have to spend a little bit more time inside the order block. What's it going to go? It's going to go right down here and to tend to this volume imbalance. Okay, so we're not going to talk about that. I just threw it in here for extra credit and no extra charge. But we have the order block that's extended out in here, right in here, as price was trading down in this candle. When that candle closed, that very day, the last trading day of that month, okay, of September 2018, you go into it with the expectation in October, we're going to anticipate a up candle. Now again, these are monthly candles, so we're anticipating a monthly candle or a range expansion on the upside beginning in October. Okay, so with that said, what are we aiming for? Well, we have this old high right here, and we also have these old equal highs relative. This is our draw on liquidity, this high here. So we know that if this is a monthly chart, this level right here may be something else on a weekly chart, or it may be something on a daily chart of greater significance. And by that, I mean equal highs, like the original number 3 model presentation described. So in this area here that's shaded, this is going to represent that October through December bullish commitment of traders. Again, relative to this here, it's just opposite, okay? We're just reversing that whole viewpoint. Okay, I'm dropping down into a weekly chart here. And now you can see even the last down close candle, extend that out in time, beautiful bullish order block, hits it right there, okay? All we need is the direction of the monthly expansion. Each week, we have the possibility of taking one shot, one kill in that direction, or we get in sync with this market move and we hold it over several weeks. Now, that high on the monthly chart, look what it becomes on a weekly. Equal highs. You see that? Now, this just happened to form in the very market that we talked about in the original presentation, but now we're looking at things on the opposite. We were bearish back then. We're looking at bullishness on the dollar CAD. So if we're looking at these equal highs, that's going to be a draw on liquidity. Trading into a weekly order block, we're expecting the monthly order block to send price higher. So if that's the case, and this is when we're expecting that COT data, all through this period, COT from the hedging perspective that I taught you, and just showed you again with this chart here, it's all bearish in the futures contract, but it's bullish all through here. Okay, in other words, it looks like this. If we frame that out with vertical lines, this is the period at which that same COT chart here was bearish for Canadian dollar. It's all bullish here, and look at the beautiful delivery of price. Now, if that doesn't get you excited, okay, if that does not get you so amped up, learning what makes these markets move like this, you don't see this stuff in retail books, folks. You just don't do it. Larry Williams ain't doing this, okay? I'm going to tell you right now, he's not doing this. No one's doing this but the ICT click. So I want you to really appreciate it because the amount of detail and confidence that it gives you, knowing it, is phenomenal. It really is phenomenal. And if you trust it, you're gonna find that you're able to do swing trades a lot easier because you're studying past back data. And as a kind of like inside note, tomorrow, which will be Saturday the 20th of April 2019, the teaching lesson will be how to do back testing and how to build a collection of data, so that way you can start building confidence around what you're trying to do in the charts. Because a lot of you have a lot of theory, you understand it, you're familiar with it because you heard me talk about it, but now we're going to start moving into what do you do with this information, start building out some practice sessions where you don't need me telling you to do each week. Here's a specific challenge. You'll know every day what you should be doing and how to collect that data and how is it useful. All right, so we have the down closed candles in here. That's our bullish order block as well on the weekly. Then we have this candle right in here. See that? This down closed candle is right before these equal highs. So yes, we could have been buying right on this candle here. And actually I have this already on another chart. Here's the dollar CAD, the market trading down into the order block here. This is the beginning of October. I'm going to take that out now so you won't need it. So when price moves away, we come down into the order block here. That is an opportunity to be a buyer. We can go long. What's the point of entry here? What's the target on it? What are we looking for? Well, we have two candles here on a weekly basis. This is an initial target. Why? Because these are equal highs. This up close candle and this down close candle, they're relative equal highs. When we drop down to a daily, it'll be more apparent. But we also still have these equal highs here. Okay? So you're going to need to watch this video a couple times because I'm going back and forth between several time frames. But I already warned you, April, we're going to get into a little bit more detail. And it's going to be harder for you to just watch the video one time and think you know it. You're going to have to chew on these lessons because it's a lot more things involved. Okay? You have to compare and contrast things. And that's why it's important for you to do this stuff in your own charts. But we have an area here that's relative equal highs, and this obviously is equal highs. No doubt about that. This down closed candle, price trades down into it, hits it here as this candle right here, this weekly open, trades down into this order block. Why this order block? Why not trade all the way down here? Because it already did that. Institutional order flows already started to show you the signatures are in place, but this order block has been capitalized, rallied up. Wait for a down closed candle. We have one. Is it before or lower than our original draw on liquidity, which is the equal highs? Again, think about what was taught to you in model number 3's original presentation. When we have equal highs, okay, and we have a period of when the market is bullish, like we have here, the COT data, it's showing that. That's all occurring in here, right in here. It's just all bullish during that period. And I'll put the vertical lines on just for completeness sake. Okay, that's the end of September and last day of December. So all of this period between these vertical blue lines, that's all when commercials are really, really bearish Canadian futures, which is bullish dollar CAD. Okay, so I'll leave these on here. And this is the weekly order block. Price trades down on this candle here on the 2nd of December. That's that weekly candle. So the week of December 2nd, that's when we're looking to enter to get a run on the equal highs. Again, the premise is it's a swing trade. We drop down into a daily. Here's that open. We trade down. Look at the candle here. Here's the 3rd of December. The 3rd of December, we trade into the order block. We could be a buyer here with the expectation of the equal highs as the upside draw. The low on this is 131.60. We'll call it 131.59 is the low, but 131.60 is the actual 10 level. The draw on liquidity is 33.84. Because they're equal highs, then we know that it's likely going to sweep above that, right? So what does that mean? 133.85 is a draw on liquidity. So between 133.85 and 131.60, we have well over 100 pips, right? Several. We have over 200 pips available on this setup. So as a swing trader, buying here, where does your stop go? It has to be below this low right here. Okay, what is that low? The low is 131.26, so our stop has to be about 10 pips below 131.25 or 131.15. That would be here. There's your stop. Your target is above here. So how many days does it take to get there? Well, you're buying on this day. As it slams down in the order block, what's the price? Anything below these equal lows, you see that? Equal lows. Liquidity's resting below that. It also tags the order block, trades in the order block here. Buying it, going long. Stop goes here. Do you need to be in intraday charts to do that? No. Because you can see the equal lows here. You can see this low here, and you have to be below that. Okay, so there's your stop. You can see these on the daily chart. Do you need to go into a lower time frame? No. It helps. It helps to do that, but you don't need to. Okay, so this model is for people that have that. It's the working man, working class hero model, where you have jobs, man. You have businesses. You have things that prevent you from being a intraday junkie. So if you can facilitate a trade using intraday concepts, it will reduce this stop to something smaller. But we're not going to teach that here. I want you to focus on this level of perspective. Okay, just know that you can use all the intraday scalping and day trading model to complement this area in here to reduce the overall risk and not have this such a wide stop. And you can leverage more, but not open yourself up to larger risk. But we have over 200 pips available, and it's been offered over the span of 3 days. So this movement here, this is a classic swing trade. Doesn't take very much time to get there, over several hundred pips, but beautifully illustrated using everything that was taught to you in Price Action Model number 3, original presentation. If we look at the 4-hour chart, which is something that you can do because it's still friendly. It doesn't allow for a lot of time pouring over the chart. It doesn't take much for someone that has a job or a business to just quickly open up a chart and see where we are on the 4-hour chart. And in here, when price was dropping down, we know there's an order block here. It trades into that. It does it again here. Then price starts to rally away. These down close candles in here, anywhere inside this range, you could be a buyer. And your stop would still be down here. Everything still is the same. They're close proximity entries. You learned about that in the mentorship. So you could see this open here when it was trading down again. Okay, you can feel confident that this run down, all this is doing is closing up a fair value gap. What's the gap? Well, we have this candle here, extended out in time. Price only draws up through it with buy-side delivery. It opens on this candle and then trades down. So as it was feeding back into this upside delivery on price, buy-side delivery creates a sell-side imbalance. This candle here opens, trades down, rebalances the sell side, and then after it does that, price is then allowed to move to the upside. What's it attacking? This level here, that 133.85 target. And look how fast price gets up there because it's seeking that liquidity. On a 4-hour, okay, on a 4-hour, we have equal candles here as well. Okay, that's a liquidity pool. That's a liquidity pool. Anything above equal highs or below equal lows is a liquidity pool. When we know they're that clear and that apparent, that's what a liquidity pool is to me. It's not going to a website and seeing where there's supposedly stops building up. I don't have any faith in that. They're not going to see those orders because orders are able to be pulled. In other words, removed from the marketplace. when you see old highs, old lows, okay, that's where liquidity is going to rest. It's obvious. It's classic, simple. You know where the stops are based on the chart, okay? And that's what I trade. I trade outside the chart. I'm looking at things outside of these candles above it, and I'm looking for things below the candles here that are outside the chart. There's nothing down here. But I know there is. It's liquidity. You know there is liquidity. The chart, no one's thinking about this area up here, or the expansion of 10, 20, and 30, or 5, 10, and 15 pips above. Okay, that's how we internalize, because we look at institutional order flow and pairing of orders. That's completely diametrically opposed to what, as we learned when we first get into the marketplace as retail traders. What's this candlestick formation? Is it a doji? Is it a hanging man? Is it a dark cloud covering? It's nonsense. That's why none of that stuff works. So when we change our perspective and that model of market efficiency paradigm is acquired and now utilized in our analysis, we don't look at the marketplace as a retail trader. We look at as an institutional trader. Because as an institutional trader, we have to know where the counterparty liquidity is. Now, what I just said is completely the foundation to what makes me ICT. My perspective on price is diametrically opposed to what you're taught and what everyone else is doing in the retail scope. That's why my strike rate is high. That's why my accuracy is high, because I'm not doing what everyone else is doing. I'm not thinking like what everyone else is thinking, and I'm not teaching you to do that either. I'm telling you how to think like a predator. We're looking for the herd mentality. Okay? The herd mentality is going to be attacked. Not all the time. Sometimes the herd will be allowed to move like it does here. It's moving up. Well, it's moving up because it's supposed to. Now it's allowed to move that direction. But once it gets here, okay, once it gets above that, then our mindset says, okay, now I'm going to look for the sick cow. I want to see that sick wildebeest, okay, or that sick deer, or the one that's confused and doesn't know what it's supposed to do. It thinks, okay, well, the crowd's been going here, the herd's going higher, it wants to go further still. No, we attack that. We sell short in here, okay, or we sell our long positions that's been acquired down here. Why? Because the counterparty is above these highs and above this 33.85 level. Okay, so once this takes place, we expect the market to turn direction. We see that happening here. What's it doing? We have a buy side imbalance. Buy side imbalance, sell side inefficiency. Price comes down and rebalances it in here. What is it doing? It's giving an opportunity to build in more sentiment. It's interesting that we have a fair value gap in here. Not a large one, but it still comes down and rebalances that. Then what does it do? It has to come back up and rebalance this area here. Between this candle and this candle, it's a SIBI. Sell side imbalance, buy side inefficiency, which is rebalanced here. Then it creates these equal highs in here. All of this creates what? Another liquidity pool, right? Or equal highs. Everything that we just disclosed and talked about in this model here, if you are a short-term trader, the same thing applies for this area here. And I'm just tossing this in there because it's too good not to talk about. But we have a BISI here, buy side imbalance, sell side inefficiency, order block, which makes this order block, this down close candle, high probability. Why? We have equal highs, and then between this high and this high, we have a relative equal high. This is liquidity resting and building up here because they're going to be chasing this sharp move down. What's retail thinking? Oh, this is that 1, 2, 3 drive pattern. No, they're going to be seeing momentum divergences in all these highs. It's not there. Creates liquidity. They're going to be chasing this as a 1, 2, 3 top. Okay, all kinds of harmonic patterns. They're going to be screaming, saying, hello, this is a short. When price is dropping down, they're going to feel rewarded. They'll probably chase and buy, sell more of it, which builds a larger liquidity pool up here. This order block, when it trades there, you're a buyer. Shooting above here, that's our liquidity. It does it there. But then we start doing the expansions of 10, 20, and 30 pips above this highest high. That highest high would be 134.43. So we could go 134.73, which would be maybe reaching to 75. Okay, 34.75. And that would look like that's close enough. And it hits it here and sweeps it. And then we get that rejection and goes lower. What is it doing right there? It's coming back, filling in this BISI, buy side imbalance, sell side inefficiency, trades back down, hits the order block again. Why? Why is that an order block? Because we have an imbalance, we have institutional order flow calling for higher prices, and why this price here, 134.75? Remember, we had that longer term, higher time frame, 133.85 down here. Okay, if we go out to the weekly chart, we talked about this area right in here. Let me zoom in. We talked about this void right here. This is a SIBI. Sell side imbalance, buy side inefficiency. What's it going to want to do? It's going to want to fill that in. So I just gave you all of the ways we can use a 4-hour chart to get in sync with that larger price move and capture all of this run here. How many pips is that? Right in here, it says equal highs, going in around 33.85. Okay, consolidations around that old equal high area here, runs beautifully up into, and again, all during that time when the COT hedging program I showed you, again, this area here, bearish Canadian, bullish dollar CAD, expansion to the upside, this area right here. Go back and look at the charts, folks. I talked about this area right here, and it went right up to it. Filled it in. This is the reason why I said that, based on everything I'm showing you here. Well, wait a minute, Michael. Why didn't you do a swing trade? I've already told you that's not how I trade personally. But I use that analysis, and that's how I do my weekly analysis with you. Now, looking at the chart right now, we have the opportunity. Give me something right now, Michael. Right, and this is what we're going to do. We have down closed candles. The market trades down into it. Bullish order block. Hits it. Rallies away. But now look what's happening. We're consolidating. What's left here? What's in here? Is equal highs. This is on a weekly chart. Isn't this same thing right here? This? Yes. Absolutely it is. So if we drop our horizontal line here on this candle here, we're going to be looking for 135.60, 135.65 in that area. Specifically, the candle's low is 35.63. We'll just round it to 60. $35.60. There we go. And now we can drop into a daily chart. Liquidity void, equal highs, runs above equal highs. It could expand up into, like we saw here, okay, all this movement here, it could see that run up into this area here. So 135.60, that's my target. I'm looking for dollar CAD to do that. Okay, what changes it? We lose this low here. Okay, we have equal lows. We've already swept that. Everything's looking like this thing wants to go higher, and now you can paper trade it. Okay, start looking for down close candles on the daily and 4-hour chart. Paper trade them as a long until we get above these equal highs and up to this level here. Okay, so hopefully you found this installment insightful. Hope it built your understanding about Model 3 a little bit more. If anything, it's giving you something else to study and go back and look at. And now you have something to go forward and forward test based on what I just shared with you here. Until I talk to you next time, I wish you good luck and good trading.